Hey everyone! So I read this article on NPR that I'm going to link below, and it talked about how car sales have been booming in the US, but car loans have also been extending their terms to about 74 months. That's more than 6 years of your life. So how do you get a car loan? Well, all you have to do is walk into a bank and say, hey, I'd like a car loan, and you'll probably have one in 20 minutes. Unfortunately, how you get out of a car loan is by paying it off. Things you should know before going to the dealership. First, do your research online. Get online, look up your dream car, then get on your bank account website, look at your bank account, reevaluate, and then go back to the car website and look for a more realistic car. So how do you know how much you can afford? Well, one way is going to the bank and saying, hey, how much will you lend me? But I don't suggest you do that, being as the last recession was a result of banks lending people more money than they can afford to pay back. Or you can have cash, as much cash as you possibly can before buying a car. If you're not in a hurry to buy a car right now, but you know it's inevitable, start saving now. Take $30, $50 out of each paycheck and put it into a savings account specifically allocated towards that car whenever it happens. So when time comes, you have a good cushion to start off with. If you are in a hurry to buy a car, assume that car payment as of now. If you think you can pay a $250 car payment every month, start paying it now into a savings account. And 6 months from now, you'll have $1,500 at the very least to cushion that loan. The more cash you have up front, the less interest you will end up paying. So how do you calculate interest? Well, you can use this crazy formula, or you can go to websites like bankrate.com, I'll link it below, and use their auto calculator. It's really easy to use. You just plug in the loan amount, the interest amount, and the term, and it'll give you the total monthly payment, and it will show you the amortization schedule. What was that? An amortization schedule. To amortize literally means paying something off in a scheduled amount of time. So what you want to do is you want to look and see how much the cost of the car will actually be by the end of the term of the loan. So as an example, if you use any calculator, I'd say use bankrate.com, you plug in $12,000 for a car loan. Let's say we get it at 3%. The interest for car loans varies across the country, and Bankrate also has a cool feature where you can look up the rates in your area by zip code. So do that first and use that rate as your example. So like I was saying, $12,000 car loan, 3% interest, and let's use this new 74-month trend that's been happening. If you do that, you're going to end up paying about $1,200 in interest by the end of your term. That's 6 years later, you will have paid $13,200 something for your car. The importance of paying additional money onto the principal each payment makes a big impact. Just in our last example, the $12,000 car, if you pay an extra $50 a month, you're going to have saved yourself about $300 by the end of the term. Plug it into the calculator. It allows you in the second part of the calculator to add additional payments to principal, and you'll see what your savings is at the end of the term. And if you save those $1,500 that we talked about a minute ago, you will have taken that $12,000 loan down to a $10,500 loan. And if you also paid the $50 extra in principal a month, you will have saved yourself about $400 in interest by the end of the term. Don't forget that interest is the fee that you're paying for not having the cash up front. So do yourself a favor before you go to the dealership and have done your research, have as much cash in the bank as possible, and don't budge on your budget. Make sure to like this video if you found it helpful, comment below to suggest future topics, and subscribe for more personal finance and budgeting videos. Thanks for watching.